Good morning, everyone, and thank you for joining today's webinar. Um, Before we get started, I would like to do an acknowledgement of country. I'd like to acknowledge that I'm hosting this webinar on the land of the Gadigal people of the Eora Nation, the traditional custodians of this land, and pay my respects to their elders, both past and present. I acknowledge the traditional custodians of the various lands on which you all join us from today and pay my respects to the Aboriginal and Torres Strait Islander people joining us online. So before we get started, I would just like to do some housekeeping. So I'd like to draw your attention to this slide that's currently showing on your screen. So to start, you're all automatically muted, but we'll be accepting questions throughout the session. And if we have time, we will answer these at the end. So you can submit these questions using the question tab, which is shown on the screen. If we run out of time to respond, we'll follow up with you after the webinar concludes, but please submit these questions throughout the webinar. If you're experiencing any technical difficulties, please click the support button, which is one of the bottom tabs on your screen. And finally, this session is being recorded and all registrants will receive a follow-up email containing the slides. A link to the recording, access to register for future webinar sessions and contact details of today's speakers. So I would like to introduce us to everyone who will be presenting today. So I am Elizabeth Blunt and I'm a partner in the Melbourne office at BDO. I'm an audit partner and I specialise in audits of not-for-profits, and I'm the lead not-for-profit industry partner here in the Melbourne office. I'd like to introduce you to Anthony Whyte, who is our national leader in the not-for-profit industry group, and he is based in our Brisbane office. Aletta Boshoff, who I'm sure many of you recognise, is our national leader in the IFRS and corporate reporting and also national leader of sustainability. She is based here in the Melbourne office with myself. Oliver Straker is in our wealth advisory team, who is conducting a very interesting session today. And he is also based in our Brisbane office, and Nick Kervin is a partner in our digital and technology advisory team. And we will all be presenting at some stage during this webinar. So firstly, I would like to introduce you to Oliver, who will be providing us an investment update.
Thanks, Elizabeth. Good morning, everyone. Thank you very much for your time. Hope everyone's nice and warm around the country this morning. In typical Queensland fashion, it dropped to below 20 degrees this morning, so we're all freezing up here.
I don't feel sorry for you, Oliver.
I know. I looked up what temperature it was in Melbourne, Elizabeth, and it made me feel a lot warmer. Look, I'll get you to go to the next slide. Thanks, Elizabeth. So look, for those of you who don't know, our private wealth team, we look after portfolios for our for-profit and not-for-profit clients. A lot of the charities we deal with, investments make up a really important part of their revenue streams. It's a nice diversifier away from government grants, donations, and it really helps with the going concern of the organisation. So today what I'd like to do is just go over a bit of a market update, and then at the end, in terms of risk, I'd just like to share how we approach investment strategies for not-for-profits. So here you can see I've got the one-year returns to 30 April across your major asset classes. It's been a pretty extraordinary year, mainly because what we've had is inflation has dropped, not to the levels that we'd like it to be, but it has come down without causing recessions around the globe. So that's what economists like to call a soft landing. I'm not going to say we're quite there yet because interest rates are still high, and that inflation figure historically is quite hard to get below 3%. So I'll go into a little bit more deeper information on each of these asset classes. But just off the bat, I'd like to highlight those two red figures I've got in there. Now, bonds in portfolios, they're typically your defensive assets. You can see if you get this wrong, they can produce negative returns. And when you've got inflation running at 3.6%, this can really eat away at your capital. And this is a common theme we've seen with a few not-for-profit portfolios that are typically more on the defensive side. You can also see that your return out of an average term deposit over the last 12 months, remembering that term deposit rates weren't where they were 12 months ago. Again, just rolling term deposits, you're losing out to inflation. So those two strategies are typically used by not-for-profits quite a lot. So I just wanted to highlight the benefits of diversifying across the asset classes. So we'll just go to the next slide. Thanks, Elizabeth. Okay, so the Australian market, the major drivers have really been interest rates, commodity prices, and consumer behaviour. So you can see there's a fair bit going on in these graphs, but you can see on the left-hand side, that's your headline CPI in that light blue bar. And then on the right, which is quite interesting, you can see those different bars that actually make up those inflation figures. So the ones that I think the government's going to find quite hard to get down, and what a lot of your charities are involved in is housing. So housing takes, as I'm sure you guys are aware, if you're out there building homes, it takes a very, very long time for you to get DA approvals, to break ground on any construction, and then the cost of materials is also still quite high. So I think the government's going to find that piece of the CPI bucket, remembering that CPI is just a basket of goods, and housing and energy make up a really big part of that basket. So I think they're going to find that quite hard to get down when you look at that blue, which is the housing ex rents, and then the rents. This going to remain quite sticky. So the next slide, thanks, Elizabeth. This is also quite interesting. The left-hand side, you can see consumer sentiment, and then on the right-hand side, you can see the real disposable income growth here. So what you can see is labour income. You can see that light blue bar on the right-hand side graph is still up, it's still increasing, but when you work out the prices of everything, the real disposable income has only just slightly gone positive. So I think this just highlights, again, what a lot of your charities are involved in. The average Australian consumer is still under quite a fair bit of financial stress, considering that even if their wages are going up, everything else is outpacing it. And that is why that's influencing that left-hand side. So in terms of what we're monitoring of our portfolios, we're keeping a really close eye on those default rates in Australia, which most people don't know this, but it's actually at one of the highest levels it's been in over 20 years. And it's really revolving around the construction and accommodation and food services. So your restaurants, your builders, your property developers, that's where a lot of the defaults are coming through. Now, this graph is alarming when you see how high it's ticking up, particularly when you look at what it's compared to, like the GFC levels. We're getting up higher than those levels. But what you also have to remember is the government basically didn't let businesses go bankrupt through COVID. They were allowing businesses to trade insolvent. Now that rule is slowly winding off. A lot of those companies that are really zombie companies are now being forced to wind up. So it's both a combination of higher interest rates, but also companies just trading insolvent for the past few years. We're also looking at fund liquidity. So there are a few funds out there that are starting to lock up withdrawals. It's only a handful at this stage. I don't think it's anything to get too concerned about yet, but it is something worth reviewing if you do have some of those property funds in your portfolios. And then the last thing is just the financial health of the consumer. At the end of the day, particularly your middle income consumer, that's where we're really looking at credit card delinquency rates, mortgages in arrears, just to try and gauge the health of the consumer. At the moment, the consumer seems to be okay, definitely not as bad as in the US. We were concerned the past 18 months of the big roll-off of those fixed-rate mortgages. When everyone fixed you could only fix up to about 4 years with most banks, between 1% and 3%. Most of those mortgages have now rolled off, and it hasn't caused a huge default cycle that some economists were predicting. So that's good news. The consumer is still hanging in. Thanks, Elizabeth. So your savings rate, you can see there on the left-hand side, is dropping, but it's starting to tick up again. On the right-hand side, if you compare that to household debt and the debt service ratio, so you can really just see your debt service ratio and your household debt. As interest rates have come up, you can see that now the debt servicing is taking up a fair bit of Australians' wages, and household debt is now starting to come down, which is good, but it's still very, very high. Thanks, Elizabeth. Okay, so internationally, most of your portfolios will definitely have, well, I would hope they would have some international exposure. In not-for-profit portfolios, the Australian market is important for franking credits, but internationally, the US market makes up over 70% of the global market cap weighted index, so it is important to diversify your portfolios there. The major drivers of international markets at the moment, probably no surprise to anyone here, is inflation and geopolitics. Inflation is coming down, but it seems to be a global phenomenon that everyone seems to be following the US. The US is such a behemoth in the global market that it tends to export a lot of its own problems. So inflation, when the US economy has actually been humming along quite well, so it's sucking up a lot of the global resources and keeping inflation high. It is coming down, but we think that they are going to find that final leg tricky, like ours. And the emerging markets, it's a bit all over the place there as well with the inflation. Thanks, Elizabeth. Elizabeth, just the next one.
So I did update to the unemployment and wage growth slide.
Yep,
Can you
yep.
see that?
Yeah, can we go to the next one?
Sure.
Thank you. So the other piece is geopolitics. So at the moment, you've still got Russia and Ukraine, but the one that the markets were concerned about, obviously it's terrible what's happening around the world, and the loss of life has been just horrible. But in terms of the financial markets, what it means in the Middle East is really oil prices. Now, oil prices feed into everything. People often don't understand how oil prices work, but your oil prices feed into so many consumable goods, including a lot of food prices. So, for example, a lot of pork comes out of China, which needs fertilizer, which has a lot of oil in it. So when oil prices spike up, you'll typically find forward guidance on inflation also goes up, which can impact interest rates. It's also so connected. Now, what is concerning financially about what's happening in the Middle East, forgetting the other implications, is so much oil comes out of that part of the world that if the conflict spills over, there's a few straits around the Middle East where over 30% of oil and natural gas is exported. Now, if something happens and Iran and the US are pulled in to the conflict, then Iran historically has held hostage some of these straits. So it doesn't even mean production has to drop, but it means that it can't be exported, which is effectively the same thing. So you could see a spike in oil prices. Now, more recently, the market hasn't been too concerned about this. Oil prices actually dropped down to the lowest levels since February, as at this morning, which is a good thing. And I think that's probably a combination of a few things, but it's really just showing that higher interest rates around the world is starting to affect demand. On the right-hand side, we've got food prices. Again, cost of living crisis. The world is so connected now that the Ukraine conflict had major impacts on food prices. You can see on the right-hand side, that left production of wheat prices, you can see the drop in the production out of Ukraine actually did start to affect globally the production of wheat. They were the fourth largest corn exporting country in the world the 3 years leading up to the war. And so this, I think this is going to have long-term implications because even if the war is resolved, all of that land, which is really good, productive land that feeds Europe and the Middle East, all that land is going to be full of chemicals. A lot of it is mined now, so I think that's going to have long-term implications for food prices too. Thanks, Elizabeth. So look, that was all just a bit of doom and gloom. So I just want to highlight some really great things in the market lately. So in portfolios, we still quite like the US market if we can get the right prices. Just wanted to highlight here on the left-hand side, in the top left-hand side, you've probably heard NVIDIA being spoke about. It's historic, the rise that this company has had over the past few years. And the real reason for it is the AI boom. So all of these AI things that you use, ChatGPT, Gemini, they need really specific chips. So NVIDIA has gone from 2022 net income or profit of $9.75 billion US to $30 billion. And that's the last quarter, that's gone up even higher. Compare that to a Woolworths, a household name, that net income of Australian billions is 1.6. So the size of these US companies is just huge, and their balance sheets are very strong as well. So we still quite like these companies for portfolios. Thanks, Elizabeth. Also on the defensive side, bonds, the corporate bond market, not the government bond market, we see can be quite attractive for the right investor as well, if it suits your risk profile. So NAB recently raised capital only last week, and some of our clients picked it up for 6.35% over 10 years. So obviously these aren't risk-free investments. They do still come with risk, but compare that to a few years ago, and a similar bond might be raising between 2 and 3%. So for the right portfolio, we see that it could be a good spot for some of the defensive asset allocation. Thanks, Elizabeth. So look, I just wanted to finish off, wary of time. In terms of risk, this is how we set up portfolios. So your portfolios, you're really fiduciaries on behalf of your stakeholders, the people who donate to you, the government who gives you grants, but also the users of your funds. If you're a foundation or you're a medical research, your portfolio should really be thought about on behalf of those users. So I think the way we set up portfolios is we set your objective. So what do you want out of this portfolio? If you need all the money in 2 years, we wouldn't be investing in shares, for example. You should stick to cash. But the longer we look out, the further we can diversify the portfolio. And then we write an investment policy statement, which is really the board saying, this is how we have thought about our investments on behalf of you, the stakeholders. And so at your AGM, or if you have questions from the stakeholders, you now have a clear document that shows that you've really thought about how you've set this portfolio up. Then we provide education for the investment committee or the board to say, this is actually what you're going to be investing in, and this is how it might react to different markets. Then we go to the analysis on how do those investments look for the next 10 years? How did they act through the GFC? How much money, how much unrealized losses would have you had through COVID or the GFC? And then we create the investment strategy. Then we move to the actual investing the funds. And then the fifth stage is the ongoing review and monitoring of the portfolio. So how is the market changing? How is the organization changing? Do you need capital in 5 years? If so, should we lock that away in term deposits or bonds? So it's really an ongoing service that in terms of risk, it helps mitigate risk in terms of market risks, but also risks to your organization to show to the stakeholders that you've actually thought about the investment strategy. So I think, Elizabeth, that's
Thank you. Oliver. That was excellent and very interesting. So a lot of our clients have 30 June financial year ends. I guess you're expecting to see any significant changes in the market within the next month?
What you'll find for the next month it will be the CPI reports, and there are some earnings results coming out of the US. So what we've been noticing the past 12 months is the big macroeconomic figures that come out of the US. If inflation runs hot this month, the market will react negatively because it means that interest rates are going to stay higher for longer, and you'll find the next day that'll affect the Australian market. So that's what I would keep an eye out for.
Excellent. Well, thank you so much for your time today. That was really interesting, and I hope everyone on the webinar has found it as interesting as I did. And thank you for coming on screen, Aletta, because we are now going to hear from Aletta in regards to sustainability and greenwashing.
Thank you very much, Elizabeth. Now, we've talked about sustainability, I think, now for a number of years, but finally the rubber is hitting the road, or you might say, oh, please don't. So first of all, a bit of a recap on what do we mean by sustainability, and particularly in a not-for-profit context. So what we've always said is sustainability is incredibly broad. So it is environmental aspects, and there's social aspects and governance aspects. I think the one area that not-for-profits are particularly good in are often all the social factors, because not-for-profits do amazing work for the community, looking after health and safety, looking after human rights, etc., diversity. But if we look at sustainability, an absolute huge area. We know in the media when they talk about mandatory reporting in the annual report, and in the media about sustainability, it's often equated just to climate change and emissions reduction. But I wanted to start by saying, remember, sustainability is incredibly broad. And actually for not-for-profits, really important to identify what of this is important to you and your stakeholders. Now on the next slide, I've got an example of what one would expect to see after you've engaged with your stakeholders. So one would go to stakeholders and say, these are the 24 factors across environment, social and governance that's captured within sustainability. You, our important stakeholders, which could be donors, it could be staff, it could be people who use your services, etc., and ask them, what would you like us, our not-for-profit, to focus on? Where do you think we can make a difference? So on the one side, we've got importance to your stakeholders, and at the bottom, we've got importance to the company. And there where you find the overlap, that green block on the top right-hand side, that will be our focus. So this is an example of what we've done for our business. And we've come up with the key things that our stakeholders at BDO Australia want us to focus on. However, we're currently doing this for many not-for-profit clients where we're saying, of all these criteria as stakeholders, what would you like us to focus on? So I think for a not-for-profit, forget about mandatory reporting. You have to focus on your stakeholders, doing a stakeholder engagement, or we call it a materiality assessment, and see what they want you to focus on. So that's step one. If we then go on and consider, why is sustainability really taking off now, today? And there's been a huge shift over the last number of months. It's a combination of the following. For some businesses, it's all about the strategic imperative. Our stakeholders, our customers, our clients, our staff, our donors, strategically, they want us to action sustainability. So there's a strategic angle. For others, it's the compliance angle, saying, listen, we know there's legislation to mandate sustainability reporting. We have to get ready for that. And we know for not-for-profits, the biggest focus is the strategic imperative. Compliance imperative, I just want to warn you maybe about that one, not to ignore compliance imperative because you are a not-for-profit. Not-for-profits who lodge financial statements with the ACNC are not caught with the new mandatory sustainability reporting. However, if you are not-for-profit who are preparing and lodging financial statements with ASIC, you would be doing that under Part 2M of the Corps Act. You are still caught by mandatory sustainability reporting. So just be a little bit careful. It's not completely outside of scope for all not-for-profits. If we just focus on the strategic imperative, which I know is the biggest thing for not-for-profits, it's all about access. Now, Elizabeth, recently when we had that roundtable lunch in Melbourne, and we were looking for topics and asked people, what do you want to discuss? Sustainability was a very dominant topic. And it was around access. And, we said, why sustainability? And it was about access. Access to capital, which for a not-for-profit is in the form of access to donations, access to government grants. And the people in attendance, the not-for-profits in attendance, clearly articulated that government is looking at sustainability, and therefore government would like to see certain sustainability initiatives and measure in order to continue to give funding to not-for-profits. We also know large private organizations, philanthropic organizations are looking for sustainability. So access to capital is access to funding for not-for-profit. It's also access to markets. People customers and clients want to make sure that organizations are moving in the right way. They want to partner with you, access your services, and then people working in the organization. I think a big driver for not-for-profit strategically is access to funds or donations. The other thing that's interesting here is if we have a bit of an overlap, you're right, Elizabeth, on the next slide, if we have a bit of an overlap on sustainability reporting, as we said earlier, yes, strategically, there's a focus on not-for-profits for the strategic imperative, and a lot of it, therefore, is voluntary reporting, various frameworks that you can use to tell your story voluntarily, what you're doing across all these metrics that was important to your stakeholders. So all the blue blocks, it's voluntary, it's aimed at your stakeholders. The green blocks is the mandatory reporting, which I'm saying, just be careful, just make sure you're not caught because you're lodging with ASIC, for example. So important to have a look at that. The strategic imperative, a bit of a recap, we've talked about this. There's a lot of frameworks you can use. And then BDO also has a checklist that can get you started. So we've got a checklist where we say we've got 5 steps on how do you assess what you currently have in place. Step 2, do that materiality assessment, stakeholder engagement. Step 3, identify the gaps. How will we fill the gaps? Step 4, we start to measure the things our stakeholders want to know. And in step 5, we report. Very important, the report don't have to be a very formal, official looking report. It could be a report to key stakeholders. It could be a report on the website. Doesn't have to be in the annual report at all, but basically you're telling your story. Elizabeth, that's about 2 slides on. If we then move on to coming back to another one and another one, if we move on to mandatory reporting, sorry, Elizabeth, I'm still stuck on the frameworks. That's the checklist. Yeah, compliance imperative, you can move on again. We know from a compliance imperative, just make sure you're not caught inadvertently. Globally, there are 2 standards, IFRS S1, S2, setting out sustainability reporting. However, what we see on the next slide in Australia, there's final legislation tabled in Parliament to bring this into the Australian environment. And the AASB also have issued an ED outlining how they will change IFRS S1 and S2. They are talking about finalizing the Australian version of IFRS S1 and S2 in August this year, so that's not that long away. And they need to do that because if you look at the mandatory reporting, it can be fairly soon. So if you're a not-for-profit lodging with ASIC, you still have to look at the size thresholds. You still have to assess whether you are Group 1, Group 2, and Group 3. It depends basically on your size, whether your revenue is above a certain level, whether your gross assets is above a certain level, whether your number of employees is above a certain level. If you meet 2 of the 3 criteria, you could be Group 1, Group 2, or Group 3. And then when will it become applicable? I've got a few not-for-profit clients that are Group 1. And then for them, the legislation is expected to come in for years beginning on or after 1 January next year. So if you've got a June year end, we're thinking 30 June 2026. A lot of not-for-profits have December year ends, so we'll be looking at 31 December 2025. So just a reminder to have a look at that. So all of this mandatory reporting is around IFRS S1 or the Australian version and IFRS S2, again, the Australian version. And what they're promoting is that you will have a new report in your annual report if you're caught by this. You'll have an annual financial report, an annual sustainability report, a director's report, and an auditor's report, where your financial report already consists of financial statements and notes and a director's declaration. Your sustainability report equal prominence to your financial report. It will initially just consist of a climate statement, so complying with IFRS S2 or the Australian version. There will be notes to the climate statement and a director's declaration dealing with that sustainability report. IFRS S1 at this stage looks like it will only be voluntary in Australia, which is interesting because most not-for-profits would be more interested in IFRS S1, because IFRS S1 is saying identify your stakeholders, ask them what's important to them, respond to that. It doesn't say what to disclose on the relevant topics, but it says at least reach out and identify the relevant topics and respond. So for not-for-profits, again, it's in a little bit of an interesting place. If we look at the next one, Elizabeth, so maybe developing a roadmap. At BDO, we've developed a roadmap to assist Group 1, but also not-for-profit entities, even though you might be Group 1, Group 2, Group 3, or not captured at all. So strategically, if you want to do something across sustainability, what are the different project streams that we see in practice? Now, the top 2 streams around carbon footprint measurement and climate-related disclosure, the maroon blocks, are around compliance if you have to do mandatory sustainability reporting, which most not-for-profits wouldn't care about at this stage. The third stream in yellow is the strategic focus, the strategic imperative for not-for-profits. And that's where you'll consider IFRS S1, as I said earlier, and that's where you'll look at assessing, prioritizing, committing, etc. Interestingly though, when you do strategy and when you reach out to stakeholders, I would fall off my chair if none of your stakeholders is interested in your carbon footprint. So most not-for-profits are actually currently working with us, looking strategically at stakeholder engagement, but also getting us to help them with their carbon footprint measurement, because all their stakeholders are saying, do you have a carbon footprint? That's something we want to know. What is your carbon footprint? Have you set a target? How are you tracking against it? So in a way, for not-for-profits, it's a combination of project stream 1 and 3. Just gives you an idea of what it could look like. Then on the next slide, I just thought, let's come back to 30 June 2024. As you know, I'm a traditional accounting nerd, and therefore I was thinking, so as a not-for-profit, what do you do in your 30 June 2024 financial statements? Now, again, whether you lodge with the ACNC or ASIC, these are maybe things to consider. So ASIC has said, although mandatory reporting of climate matters has been delayed in Australia, at this speech they said, please focus on it, get ready, don't wait till the last moment. So that's the one thing. The other thing that they've said is ASIC has released on the 15th of May already their focus areas for 30 June 2024, and often the focus areas of ASIC are fairly similar to focus areas for the ACNC across the sector. And again, climate-related risk feature and a focus on TCFD recommendations. And there's a link to an article we've written where we summarize these focus areas. So please don't ignore climate risks and opportunities if it's relevant for your business. And then on the final slide, Elizabeth, I've just put a high-level summary of the TCFD recommendations, 11 recommendations across 4 pillars. So what's your governance across sustainability, your strategy, your risk management, and some potential metrics and targets, and there you can see carbon footprint again. So very high level, appreciating that for not-for-profits, you'll only action this if it's of strategic importance. Mandatory reporting will only be relevant for you if you're lodging and preparing financials with ASIC and you meet a certain size threshold. Elizabeth, over to you.
Thank you very much, Aletta. That was fantastic. Thanks for the summary. So I'm going to hand straight now to Anthony Whyte, who is going to present to us about related party disclosures and requirements. Hi, Anthony.
Hi, Elizabeth. Thanks for that. And I back up Ollie's comments. It's below 20. It's very cold here. So in Brisbane. Anyway, feel sorry for us. Okay, so related party disclosures. So this is an area where there's some intricacies to the disclosure requirements that people don't always pick up on. And also some uncertainty as to who the related parties are. That's what we see when we do the audit. So I just thought I'd go through quickly the finer points in relation to related party disclosures for not-for-profits. So who are those that are required to include related party disclosures? So obviously, if you produce general purpose financial reports, or as a lot of NFPs do, they produce general purpose simplified disclosure financial reports, then you're required to comply with the related party disclosure requirements in the standards. So if you produce special purpose financial reports, you're also required to comply with the related party disclosure requirements. But there are a few exceptions that sometimes go under the radar. So one of those exceptions are if you're a medium charity, you do not have to report KMP remuneration within your related party disclosure. So medium charities are charities with revenue between $500,000 and $3 million. So if you're a medium charity, you do not have to include the KMP remuneration in your disclosure. If you produce special purpose financial reports and you've only got one KMP that's remunerated, then again, you do not have to include the remuneration disclosure for KMPs in your financial report. And then the other one, in relation to special purpose financial reports, you don't have to break out the remuneration into the subcategories. So short-term remuneration, long-term remuneration, and the other categories. So you don't have to do that breakout. So might be relevant, might be something that you haven't tweaked to before. The next thing I'll just mention is who are related parties. So there's very good guidance on the ACNC website around this as who are related parties. Also on our website in the June 2022 corporate reporting insights, it goes through it in some detail as well. What we often find is people just think of, okay, well, it's our board members, our CEO, CFO, and so on. But it is a lot broader than that when it comes to the definition of related parties. What some people don't think of necessarily is if there's an entity that sits above the NFP that might exercise significant influence or have joint control over the NFP, then they're considered a related entity. Similar, if your organisation is involved in certain ventures with other organisations and you're able to exercise significant influence or joint control over those ventures, then that's a related party, what you're able to exercise control or influence over. People don't always think of either the related entities of key management personnel. So if board members or the chief executives of the organisation, if they have entities that they control or that they even have significant influence over, and the NFP transacts with those organisations, well, they're related party transactions that need to be disclosed, as well as transactions with close family members of the NFP. So in broad terms, a close family member is considered to be a spouse, children, or any other dependents of the KMP. So it is quite a wide net that you need to consider. Certainly a good starting point for making sure that you're picking up all these transactions is to refer to the conflicts of interest that might be declared at board meetings or where there's a register maintained for that. The final point I will make, previously we've come from an environment where all related party disclosures are material no matter what. Well, materiality is set out in AASB 101 does need to be considered when you're looking at related party disclosures. And again, on the ACN website, it provides good guidance around that and how you do consider materiality when it comes to related party disclosures. So it's been in place for a few years now, but I thought it was just worthwhile to go over some of those finer points.
Thanks, Anthony. Absolutely. It's certainly an area of judgment that gets looked at every audit period, and it's a focus area, ensuring that the disclosures are correct in the financial statements. So thanks for talking on that. So we've given Aletta a slight breather after her presentation on sustainability, and she's back again to talk about the status of reporting update for not-for-profits. So back over to you, Aletta.
Thank you very much, Elizabeth. So really all we're trying to do here is we know there's going to be some changes to the reporting framework for not-for-profits. It's been a long time coming, and I suspect it will still be a bit of time required to finish this project. So as you know, the AASB have issued a discussion paper where they were considering how to develop a simplified set of accounting requirements for Tier 3 not-for-profit private sector entities. Now, this was already issued the 31st of March last year. The AASB is still discussing the feedback they've received on this discussion paper. I know there's been various roundtables and a lot of not-for-profits and their advisors have provided feedback. Maybe just to give you an idea what they're trying to do here is currently under the IC&C requirements, we've got the concepts of large charities, medium charities, and small charities. And the interaction with the accounting standards or the AASB accounting standards currently is that those entities will have to consider, those large, medium, small charities have to consider whether they're a reporting entity. And if you're a reporting entity, you know, if you say yes, then you will do general purpose financial statements, Tier 2 at least. You can opt for Tier 1. If you're not a reporting entity, you can do special purpose financial statements. So we still have all of that in place on the left-hand side and in the middle. What they're proposing, the AASB is proposing, is that going forward that there will be 3 tiers for not-for-profits. Now, the interesting thing here is that all 3 tiers will classify as general purpose financial statements. Now, this is a little bit earth-shattering if you think about it, because if you look at for-profit world, you only get to general purpose financial statements if you do all the recognition and all the measurement of the accounting standards, right? Otherwise, it's definitely not general purpose. Here, we can have a third tier of general purpose financial statements where there's simplified accounting. And that is really controversial in the Australian environment. So tier 1 is full IFRS recognition, measurement, and disclosure. Tier 2 is full recognition, measurement, and simplified disclosure. But this tier 3 really is very different to what we see in private sector world, in that it's got simplified accounting. And you can imagine the AASB is struggling to finalize this project, because how do we simplify accounting, still have it comparable, still provide useful information? How do we simplify accounting, and how do we still call it general purpose financial statements? Then, they're looking at a number of things. They're looking at the presentation of financials. So one of the things they're looking at is that potentially, the statement of cash flows, you can just use the direct method, and maybe no need to separate investing and financing cash flows out. So simplify the composition of the cash flow statement. They're also looking at how do we deal with consolidation within not-for-profit world, how do we deal with financial instruments, borrowing cost, employee benefits, etc. And you'll see all the topics that we have on this slide are the real difficult ones. How can we come up with different accounting rules, different to what we see in tier 1, tier 2 for not-for-profits, different to what we see in private sector world, and it's different rules, but we still call it general purpose financial statements. So really a difficult area. These are the problem areas that they're trying to streamline, and it's always that tension between comparable information with tier 1, tier 2 not-for-profits, as opposed to simplifying it for the smaller not-for-profits. So I think that's why it's taking so long. It's quite difficult to get that balance right. Some of the things they're also thinking about is, to get that balance right. If there is a transaction or an event that's dealt with in this tier 3, so there's specific accounting rules for it. So maybe for leases, very specific accounting rules for leases. Then if you're in tier 3, you have to apply that, obviously. However, if a transaction or an event is not dealt with in tier 3, and there are a number of them where they're saying, listen, we're not going to deal with it in tier 3 because a lot of not-for-profits don't have this type of transaction. If they have it, it's rare. In that situation, you have to go back to the normal rules in tier 1 and tier 2, so normal accounting rules. So for those rare, complex transactions, you'll still have to do what's in tier 1 and tier 2. Those things that regularly happen, but you're a small not-for-profit, there might be some simplified rules. So some of the things that we be looking at to not have additional rules, but you actually go back to the normal tier 1 and tier 2 rules of biological assets, service concessions, complex financial instruments, etc. Most people will ask me, Aletta, what's the timeline for this? Next step would be the AASB issue an ED, which we're hoping to see before the end of this year. Then there will be comment letters on that exposure draft, a final standard, let's say a year or so later, and we are hoping that there will be sufficient runway for not-for-profits to get ready. So I think this project is still ongoing. It will take a bit of time.
Thanks, Aletta. Just one question. If you are a large charity under the ACNC and you are still preparing special purpose financial statements, would you recommend to continue preparing special purpose or start that transition to general purpose, potentially simplified disclosures?
Elizabeth, it's hard to say. I suppose I think it's quite unlikely that this tier 3 will be appropriate for large charities, to be realistic, right? I think your large charities would most often end up being general purpose tier 1 or 2 anyway.
Yeah.
So they could start to get ready. I suppose others would say, why would I do it if it's not mandated yet? If I can still do special purpose, I'll do it for as long as possible. So it really depends on the charity. But I think for a large charity and even a medium charity, for them to think that they're going to end up in this special tier 3 with special accounting rules, I think that might be a bit optimistic.
Yeah. Thank you very much, Aletta. Now, we're giving you another break, but you are coming back at the end. So next we have Nick Kervin, who will be presenting on cyber security and changes to the Privacy Act, because this is, again, another key topic that we're seeing in the not-for-profit space. Over to you, Nick.
Thank you, Elizabeth, and I hope all the attendees are enjoying today's content. It's been very enlightening for me too. Again, cybersecurity and the Privacy Act. So I'd first like to just cover off some of the key challenges that we're seeing in the not-for-profit sector and the public and private sectors more generally. And the first is that we're starting to see a real focus around data risk, and this is linked through to the Privacy Act, which will be updated in the next couple of months, and I'll come back to this. But in essence, many not-for-profit businesses have historically collected a lot of personal information without effective data governance, and a lot of this PI is trapped in unstructured data, which is actually quite difficult to identify and remediate. As we all know, the Optus, Medibank and Latitude breaches have spawned a need to revise and review the Privacy Act, and I'll talk a little bit further about that in the next few slides. So moving beyond the risk and the changes to privacy, cyber is still a massive headache and has really gotten onto all boards' agendas over the last 18 to 24 months, including data breach reporting. The EWL Ebsworth leak was actually a really good example of a loss of unstructured data. And when we talk about unstructured data, we're talking about emails and Word documents and folders of documents that are in an unstructured format. One of the challenges that all of the attendees need to think about, and this is coming back to some of the expectations that the Privacy Commissioner is starting to expect, is that if you do lose information or leak it, or you are hacked and that information goes outside of your four walls, you are expected to let the impacted individuals know in a reasonable time frame. And in the event that it is a large leak of unstructured data, it can be very challenging to actually meet those expectations and let people know that their information has been lost. Moving on to data governance. So many organisations have been a bit blind to the importance of data governance. In a recent Macquarie University survey of 345 CEOs estimated that almost 60% say the board does not have an understanding of the organisation's data governance challenges. Now, why is data governance important? Data governance is actually a very key component of appropriately managing your data assets. And once you get your data governance in place, it will actually be a very significant support to helping with cyber breaches and understanding exactly where your important information sits. It is a challenge to get data governance off the ground, and it needs C-suite support, but it is becoming very apparent that it is a key enabler to getting your cyber and Privacy Act compliance in place. And then finally, I'd just like to touch on AI. The explosion of AI has taken place, or generative AI, over the last 12 to 18 months. There is a huge push to leverage this new technology. Our advice is, though, coming back to your data governance, you have to get your governance in place to effectively control and get the most out of your Gen AI. Otherwise, your Gen AI will be accessing data that it potentially shouldn't, and also potentially giving you advice and returning information that is not appropriate based on what it's found in your unstructured data sources. Why manage privacy? There are some headlines here that we're all aware of large data leaks. Now, I guess the most important thing to highlight is that Optus and Medibank are facing large class action legal headaches, and the class actions are based on their failure to adopt the Privacy Act principles. So this is the Australian public now militarising and essentially saying, well, you haven't adopted the Privacy Act principles and we're now going to seek some compensation for you losing our personal information. So privacy is important, and the Privacy Act is going to be updated in the next couple of months. So the Attorney General late last year made a series of recommendations, and the government has released its response to those recommendations, and it has agreed in principle to the majority of them, and we're still waiting to see what actually comes out in the uplifted Privacy Act. But I've just highlighted a few, just 4 of the agreed in principle recommendations that are relevant to this group, and that is reducing the scope of the small business and employee record exemptions that are currently in the Act. Nominating a privacy officer to be responsible for compliance is important. If you haven't considered that or don't have one, you'll need to start thinking about that. Understanding specific rules for children's personal information will be important for NFPs that deal with that type of PI. And then finally, a big one, which is the right of erasure or right to be forgotten, and customers or donors or anyone asking for you to forget their personal information, which will be very difficult to do unless you've got data governance in place. And finally, how can we help? What are the key takeaways? So if you've launched into the Essential 8 and you're implementing those controls, well done. But how broad is your cybersecurity plan? And are you moving from a compliance mindset to one of risk? Maybe a cyber maturity assessment is timely. Are you ready for the new Privacy Act changes? Do you understand your current compliance? And is it time for BDO to come in and have a look at your current posture and your compliance in preparation for the delta that will come with the new updated Act? And then finally, have you appropriately invested in data governance to support your cyber and privacy? Is data governance even on your radar? And we'd be more than happy to drop by and talk to you about governance and a roadmap that's right for your business.
Thank you very much, Nick. Some very important items covered there. And we've only got 3 minutes left, so I'm going to hand straight over to Aletta to talk about education for board members.
Thank you, Elizabeth, and I'll do this in 3 minutes. I anticipated this, so I've included a link there to the ASIC website where they discuss the responsibilities of directors, and this applies to directors of for-profits and not-for-profits. Information sheet 183 is an amazing document that you can find at that link, talking about the general duties as a director, talking about the company's duty to keep proper books and records. It's talking about financial reporting obligations, financial knowledge obligations, and also the director or the director's relationship with the auditor. Now, in the next slides, I've taken and I've grabbed extracts from information sheet 183 to explain this further. So a bit around your general duties across duty of care and diligence under both general law and the Corporations Act, and in particularly they talk about general duties and then what you must do. As a director, you have a core irreducible requirement of involvement in the management of the company. You must take reasonable steps to place yourself in a position to guide and monitor the management of the company. And that can often be very tricky, but I just wanted to re-emphasize that irreducible requirement of involvement in the management of the company. Number one, so general duties of a director to talk about. To keep your records up to date. So this is your written financial records, correctly record and explain the transactions, its position, its performance, enable true and fair financial statements to be prepared. I think not-for-profits, there's a lot of tricky bits. If you look at cash, for example, you can have restricted funds and unrestricted funds. Important in a not-for-profit context to monitor and keep track of restricted funds and unrestricted funds, as an example. So are you across all of that, and are you sure you've got all these records in place? The next one I think is around financial reporting obligations, and these are extensive. So again, for directors to obtain education on what the latest developments are in the accounting world, not just for not-for-profits, but generally. There's new rules around current, non-current classification if you have liabilities, for example. There were recently new rules on income recognition, but are you across all those financial reporting changes? And especially when this tier 3 comes in, would you be across all of that? So important to get the training. And this is just, again, if you look at financial reporting quality, that's your responsibility to make sure that we have appropriate financial reporting quality. Audit committees play an incredibly important role, and also CEOs, CFOs, their declarations and their commitment to financial reporting quality. So that's just another reminder of that. Then on the next one, financial knowledge obligations. So somewhat similar. So your own knowledge, we cannot say we just rely on the CFO or the finance team, or maybe the board member on the not-for-profit board that has the financial expertise. It's the responsibility of each and every director on that not-for-profit board to be educated, to be able to ask intelligent financial questions to make sure that the story in the financial report lines up with your knowledge of the not-for-profit. So this is a responsibility for everybody, not just the treasurer in this not-for-profit board. And then again, the very important relationship with the auditor. So what you should do in liaising with the auditor, meeting with the auditor on a regular basis. Auditor can present to you, you can ask the auditor questions. I think that's really important, and there's another information sheet around audit quality as well. And then my very last slide, Elizabeth, is just the asset focus areas, which I've mentioned earlier. Usually similar focus areas across the profession for for-profits, not-for-profits, and with the ACNC, so asset values, provisions, subsequent events, and disclosures in the director's report, and some additional items highlighted, and I want to call out number 3 on the right-hand side, climate-related risks. Thank you, Elizabeth.
Very much, Aletta. We nearly kept it on time. So just lastly, thank you very much to all the presenters who took the time to create the slides and the content and spoke today. And thank you to all of the attendees for listening. As I said, we have gone just over time, so we didn't get to all the questions that were asked, but please keep submitting your questions through GoToWebinar, and we will respond to you individually post the webinar. So thank you very much to everyone for your time today, and I hope to speak to you in the near future. Bye.